Hi, okay. I see that we have more participants joining in the session now already. Okay, so I think it is good that we start for now. Okay, a very good afternoon to all of you. I'm Jun Kit from Phillip Futures. Okay, so welcome to the day one of our CF Discovery course lah. So this is the first part of this three-part webinar series where we talk about CFDs. And in today's session, we will talk specifically on the introduction to the CFDs, because I think a lot of you may have probably heard of this instrument, but you guys are not so clearly aware of what it actually is. So in this session, we aim to to prepare not too much information for you, just to have a good understanding at a good pace of this instrument. Okay, so before we proceed, it is important to cover this disclaimer that we have. So basically, whatever that we are going to cover in this webinar is only for educational purposes only. It does not take into consideration your personal risk appetite, your investment objective, and etc. Okay, none of this would constitute as a financial advice, only for educational purpose for you to understand this instrument. All right. So this webinar will be structured in such a way where we will start with saying what are CFDs, followed by the types of CFDs we have, and we'll do some simple illustration of a profit and loss calculation on the CFD the transaction. Okay, then we'll dive a little bit deeper into some of the mechanics of CFD trading, and lastly, you will also um, learn some of the reasons that people are actually trading CFDs. Okay. So first and foremost, what is CFD? So CFD is actually it actually stands for contract for difference, and it is a derivative. Okay, so by definition, a derivative is an instrument where price is derived from an underlying asset. So the underlying asset could be stocks, it could be ETF, it could be commodities, it could be indices. So essentially, what CFD does is it derives price from the underlying asset. Okay, so let's talk back about the derivatives. Some of the popular derivatives you may know, they are like a futures, forwards, options, and swap. And I believe most of the participants today are from uni. I think we have students from SUSS, SIM, NUS, and TUSMU. So I think most of you would be from like an investment club or something, or even an investment major. So I believe these derivatives wouldn't be so foreign to you, like futures, forwards. But today we're going to talk about CFD. All right. So what is CFD? Like I mentioned earlier, it means contract for difference. So essentially what it is an agreement between two parties to settle the difference between the opening and the closing price of contract. So in this case, it is an agreement between a retail trader like yourself and a broker like Phillip Futures. So both parties would agree to exchange the difference in the pricing of the contract. Okay, so unlike futures, there will be no physical delivery of the underlying. For this part, we'll talk a little bit more about in detail later, but essentially you're just trading the price of the underlying instrument. Okay, and CFD, it is also a leverage product. It is traded on margin. Okay, so basically what CFD does for us is that it allows us to participate in the price movement of a particular asset without owning the underlying asset. So let's say today you are trading shares CFD, so Apple shares CFD. Okay, so you can participate in the movement of the Apple shares, without having to buy the shares from broker, to pay a custody fee, to pay exchange fee, all that you don't have to. So essentially, you can participate in the movement without the hassle of owning the underlying asset. Okay, so CFD essentially it takes reference from prices quoted in the underlying exchange, and these prices are normally only available when the relevant market is open. So let's say right now you want to trade Apple shares, but the market is still not open. So you have to wait for market open tonight around 10 p.m., 10:30 p.m. When the US market opens, only you can trade CFDs. Okay, so it really just takes reference from the underlying exchange lah, right? And I think I mentioned this earlier. For CFD, there's no contract expiry date. You can hold on to it for as long as you want. and it is cash settled. Okay, when we talk about CFD, it is also very important for us to understand the concept between something that is exchange traded and something that is traded over the counter. Okay, so for something that is exchange traded, which is I think more popular, that most of us will be more familiar with, are things like stocks and futures. So stocks and futures, people will go to a central location, like SGX, Nasdaq, and NYC to trade. So basically, everyone come to a same platform to trade the shares. Okay, same goes to futures. But CFD, it operates quite in a similar way to Forex, where it is traded over the counter, which means it does not have a physical location or a central exchange for CFD trading. All right, a bit about the background of CFD. It was actually first created in 1990s in London, for investors to gain exposure to many asset classes without having to physically own them. Okay, so eventually it also started to gain some popularity because it requires only a small margin to initiate a larger position. So this sentence, what it means is basically it's a leverage contract lah. You don't need a huge amount of money. You need only the exact amount of money to start a position that is of that magnitude. Okay, you can just deposit a small amount and you can trade a big contract. Okay, so that's what it means. All right. Also, I think one of the key selling feature for CFD, compared to futures, is also that it does not have an expiry date. Okay, so we'll share more about that now. Okay, so here is some of the differences and similarities between CFD and futures. I think futures, all of us are pretty familiar. I mean, we've learned this in uni in our courses. Okay, so the difference between CFD and futures is that CFD does not have an expiry date. Just think of it as like having an underlying stock, something like that. Okay, if you hold an underlying stock, you wouldn't have to be afraid or mindful of the expiry date, or you have to perform certain actions on the expiry date. You just hold it, and in a future date when you feel like it's desirable. So let's say when you've long this CFD contract, and sometime down the road it has risen in price, you wish to sell. Okay, you can do it anytime. All right. So let's say if you're still in an unrealized loss, you can just hold the position until it's in your favor, it's in the money, then you can exercise. Unlike for futures, there is an expiration date. So when you trade with futures, right, you have to be mindful on when's the last trading day. If you don't wish to take delivery of the contract during the expiration date, you would have to roll over the contract, for another period in order to maintain the same position without having to actualize or realize the position. All right, so moving on, the profit and loss calculation for CFD, it is basically just taking the difference between the spot price and the entry price. So let's say you buy something at 100 today, somewhere down the road it's 150. Okay, so when the current market price is 150, you just take 150 minus the entry price, which is 100. So that's your profit. Okay, so for futures, it would be a difference between the future price and the exercise price. Okay. All right. Moving on, some of the similarities for both the CFD and futures. On both instruments, you can go both long and short. Okay. And also, one thing similar between both is the leverage. Okay. Leverage between you can leverage for these two contracts. Okay, so basically that is a very brief overview of what CFD actually is. So essentially it is a derivative that allows you to participate in the price movement of an underlying asset without the hassle of owning the actual underlying asset. Okay, so moving on, we will share a little bit about the types of CFDs. Okay, as we shared earlier, CFDs basically they just derive price from whichever underlying asset. So under the umbrella of CFD, we have global indices, shares, ETFs, energy, and commodities, and also we have others. Okay, so essentially there can be CFDs on any contracts as long as there is a broker or a liquidity provider who is willing to to draft out the contract and to enter the contract with you. You can trade that CFD. Okay, so far CFD is pretty popular, so you can find a CFD contract on pretty much most of the popular assets that is out there. Okay, so the first type, elaborating more on the global indices. So basically, for those who may not be so familiar with global indices, basically it is a basket of individual stocks. Okay, so let's say for S&P 500 or Nasdaq 100, so this is a basket of like a top 500 companies in the US. So those people who want to invest or trade indices are people who are, either you want to participate in the movement of the entire stock market, the rise and fall, without zooming in into individual stocks. So you somehow get an average or, averaged out movement of the whole market. Okay, so for indices, there are many types of indices from various regions. Okay, so from the top three that I've listed here, they are from the US, and we also have indices from for Asia, places like Hong Kong, we have the Hang Seng Index. Japan, we have the Nikkei Index, and we also have a long list of index from other countries like Europe. Okay, so that is indices. Okay, so the next one would be shares. I think shares, all of us should be pretty familiar also. So shares, there's like shares from various exchanges like a Nasdaq, NYSE, Hong Kong Exchange, and Singapore Exchange. So these are just some of the a very few of a long list that we have. The shares CFD that you could trade the price movements of these underlying shares. Okay, so next one would be also ETFs. So these are exchange traded funds. So exchange traded funds actually they cover various sectors. We have sectors like financial, sectors like technology, and sectors like healthcare. So here are also a few examples of the ETFs that you can trade under CFDs. Okay, also with CFDs, you can participate in the movement of the Brent crude oil, the WTI crude oil, or known as UK oil or US oil. Okay, and we also do have commodities. Okay, so commodities like cotton, coffee, sugar, orange juice. So let's say you want to participate, you want to trade the movement of coffee instead of trading the actual commodity, where maybe at a future date, you have to take delivery. Your house is not that big enough to house so much of the physical goods, right? Then you want to just trade the price with CFDs. Yeah, so that's one of the selling point for CFD. A lot of institutions or those investment firms, they are using CFDs to either hedge their positions or to trade on speculation. Okay, so those are the types of CFDs that we have. And moving on, just to cover a few simple illustration of the P&L on CFDs. Okay, so here is an example on a trade on commodity. Okay, so just bear in mind, in this illustration and subsequent two illustrations, actually it is based on the assumption of a contract size. So from here you can see commodity, when you buy one CFD. So one CFD, it also means a contract size for 100 barrels. Okay, so when you go to the trading platform, you type in one CFD, automatically it means 100 barrels. But all these things, you shouldn't have to worry too much about it. When you're on the platform, you type in one, you should be able to see 100 barrels. So it is pretty intuitive and straightforward. Okay, so just coming back to this calculation, let's say you bought a CFD contract of UK oil. So one CFD equates to like 100 barrels. So assuming a price of 70 US dollar per barrel. Okay, so you bought in this contract at $70 per barrel, and subsequently you sold it at $73. Okay, so you see you bought it at 70, you sold it at $73. So although with a 3% increase in the price, your gain will be a $300. It's because it's $3 times 100 barrels. Okay, so if you can see the calculation is there, it is pretty straightforward. Okay, so in the event that you sell the same contract at a price drop of $65. Okay, so you will incur a loss of $500. So that's taken by taking 65 minus 70 times 100 barrels. Okay, so that would be your loss, a calculation of the loss made on this trade. Okay, so this is just a illustration of the whole contract value. So later on in the presentation, I will share with you how much margin or how much initial capital you would need in order to initiate such a position. Okay. So the second one is a pretty similar example. In this is you buy one CFD, which means one index, because index, they are pretty high priced. So one contract is just one index. So I think this example is an example of the US30 at 25K. Clearly, this is an old example. The price today is way higher than this. All right, so let's say you buy, sorry, this example is you have sold. You have sold one CFD at 25K, and eventually you bought it back at 24K. Yeah, and you actually make a gain of 1,000 because you short sold it at a higher price, and eventually you bought it at a lower price. So you take 25K minus 24K times one contract, and it is $1,000 profit. Okay, on the flip side, when you bought back this CFD contract at 25K and 100, okay, so basically you're making a loss now. All right. So moving on to shares, I think this is pretty similar, and I think I wouldn't bore you guys with the step by step, but you guys get a meaning lah. So basically, it is how you calculate the profit and loss with CFDs is taking the price at which you bought minus taking the price depends on if you're buying a selling. So let's say is a buy, okay, then you would take the selling price minus the price that you bought times the number of shares for the CFD contract. Okay. So for shares, there is a special scenario because shares sometimes they would get delisted from exchange. So what this means is also when the or delist, or maybe when the stock falls to zero. So this brings us to the risk of trading share CFD also. I mean, same goes to the holding an underlying stock, but CFD you're leveraged. Okay, so in the event that you bought this share at 1996 in this example, 100 shares at 1996. So in the event that the share falls to zero, you would incur the cost of the full contract. Okay, so that means you lose the full contract lah. Okay. So yeah, I think that is a quick illustration on how you calculate P&L on CFD. So one thing we need to note is the contract size that we are trading, because across different asset classes, it varies. Okay, so for indices, we normally is one CFD equals to one index. For shares, it is normally one CFD equals to one share. And for commodities, it is one CFD to 100 barrels. So, but all this, you just need to be mindful of, but not too much of a challenge. You'll be able to see all that in the trading platform. Okay, so moving on, we will go into the mechanics of CFD trading. So when we talk about CFDs, leverage product, I think it's very important to talk about margin. Okay, because we can't start trading on leverage without understanding what is margin and all that, right? Okay, so in the first portion, we will talk about margin. Secondly, we will guide you through some of the costs for trading CFDs. Okay, so first of all, let's talk about margin. Okay, so margin is basically the amount you would have to deposit to take up a trading position. Okay, so it is the amount is usually a fraction of the underlying asset value lah. It's normally a percentage. Okay, so what the margin does is that it helps to ensure that both parties fulfill the obligation. Like I'm entering into this contract, I need to put up an initial deposit to make sure that I have some deposit with the counterpart. Okay, so this to protect both sides, to protect the buyers and also the sellers. Okay, so margin, there are two kind of margin. The first is the initial margin, which is the amount required when you start a position. So on this part, let's talk about shares. Shares, the initial deposit, or rather the initial margin, is normally 20%. So to enter to a contract, you need to have only a 20% of the full contract value. Okay, so that is to start the position. Okay, so there is also something called the maintenance margin, where during the course when your position is open, your account balance needs to be above this percentage of maintenance margin. Okay, all right, so let's talk about margin, the actual calculation. So let's first talk about commodities like energy, okay, Brent crude oil. So let's say you want to trade one contract, one CFD contract of this Brent crude oil. It's like $74. Okay, so times 100 barrels. So that would bring the contract to a notional value of 7,400. Okay, 7,400. Okay, so this is the minimum size, all right. But then for us to start trading, we do not need to have an upfront payment of 7,400. So all we need to have to put it upfront is only 20% of it. So taking 20% of 7,400, we get the initial margin of $1,480. Okay, so yeah, so what you see here is really, with a small amount of capital, you'll be able to leverage 5 times to open a position that is much larger than what your capital allows you to do. Okay, so for Amazon shares, okay, so it is the same. The not benchmark margin is around 20%. Okay, so to initiate a position in Amazon, which is like taking an example price of 3,500, you would only need to have $700 initial margin to start this position. Okay, moving on to S&P 500. So one good news about this is that normally for indices the notional value or the contract size is in the thousands or tens of thousands, right? So recently we have enabled fractional trading of S&P 500 index and other indices. Okay, so let's say you think that you want to invest, you want to trade the movements of the stock market as a whole, so you go to indices. So S&P 500 itself is like 4,600. It may be a bit too high, maybe a bit too much for you. Okay, you want to scale it down a bit with just a little capital that we're starting out. You can trade this fractional index. We can start from 0.1. So from here, the entire value of that contract is only 460. All right, and the margin starts from only 5%. Okay, so essentially with only $23, you are able to participate in the movement of the S&P 500 index. Okay, so that is the beauty of CFD lah. Okay, then of course we also need to talk about the risk associated with this. So what we are seeing here is basically leveraging your starting capital by like 5 times. Okay, oh sorry, this example is 5%. It is applicable for Forex, but you get the idea. So for CFDs, it varies lah. So some are 5%, some are 20%. Essentially, you are magnifying the power of your capital. Okay, so yeah, I've talked about this. So it is really important to know that with leverage, a small price change can result in a larger profit or loss. Okay, and it really is a double-edged sword lah. So as you guys know, this is a 3-part webinar series, right? We will talk more about the risk associated in the second session, which will be held next Thursday, same time. Because the reason that we split this course into 3 parts, because in the past we've tried doing all this in just one session, and we felt that there was just too much important information to cover, that we end up rushing it through lah, and the audience don't get a good experience. So we would highly recommend you to join the second portion of this course to learn a bit more about the risk of CFDs. We'll be doing a detailed calculation of how much price movement does it take for your position to be knocked out, those things like that. Okay, but for today's session, we just want you to get a very introductory session for CFD, in a very decent pace lah. Okay, so I've talked about leverage. So I hope that you guys get the idea. The leverage can help you to magnify your losses and at the same time to magnify your profits as well. And risk management is a very important part, which will be covered in a third webinar 2 weeks down the road. Okay, so let's talk about trading costs next. Trading CFDs, what are the costs associated? Like, just now we mentioned about if you want to buy stocks in an underlying market, there are certain fees that you may have to incur, like the exchange fee and all that. So for CFDs, what are the costs? So there will not be any commissions for trading CFDs. There will not be platform fees. There will not be exchange fees. What? This example is basically on the platform that we have, Phillip MetaTrader 5. But for other platforms, we will not comment about that. But for us, so you wouldn't be charged any commission fee, any platform fee, any exchange fee, all that. So the only the two main costs for trading CFD, it is really just the spread and the swap. Okay, the spread and the swap. Let's talk about what is spread. Okay, so maybe for those of you who are just starting out, you may not be too familiar on what is spread. So essentially, is the difference. Wait, okay, before we go to the calculation, okay, so some of you may have heard of these things called the bid and ask. So the bid and ask right here. Okay, so the bid is normally the price that you sell. The ask is normally the price that you buy. Okay, so let's just ignore the image in the center, like bid and ask. I think it tends to be a bit confusing for those of us who are just starting out, because normally when you hear bid, you will associate that as buy. But bear in mind that the term bid and ask is from the broker's perspective. Okay, so it is the opposite perspective from a trader lah. Okay, so that is bid and ask. So let's talk about, let's say when you want to buy into these contracts, when you're buying, when you're longing, the price that you're looking at is the buy. Okay, by the way, this is a screenshot from the Phillip MetaTrader 5 platform. So when you look at the buy, when you're looking to buy, this would be the price that you're buying. Okay, and you're looking to sell or short or to close a long position, you'll be looking at the sell price. Okay, so I think the buy and sell, they are pretty really straightforward, just that I felt the need to just clarify on the bid and ask. Okay, so coming back to the question, what is spread? Spread is simply the cost for you to buy and sell, like given that you buy and sell at the same time. Okay, so the cost that you will incur is the difference between the buy and the sell. Okay, so the spread is calculated by taking the ask price or the buy price minus the sell price. Okay, so for this case, for S&P 500, the spread is only like 0.8 points. It's very minimal. Okay, so this is the first cost of trading CFD. It is the spread. Okay, so the next one would be the swap. Okay, swap. What are swap? So swap actually, it comprises of few components. The first component, it is actually the financing cost, because we mentioned earlier that CFD is a leverage contract. So essentially what you are doing is you are borrowing money to fund your position. Okay, so when you're borrowing money, naturally you would incur a borrowing of financing costs. Okay, so this cost would normally be incurred when you hold the position overnight. Okay, so it's an overnight financing cost lah. So that is the first one. Other than that, we also have interest rate differential. So let's say if you're buying a certain asset denominated in a certain currency, you're buying this asset with another currency. So just looking at comparing between the two currencies, okay, the currencies that of the asset and the currency that you're buying it with. So you're borrowing. So let's take an example of maybe US dollar and the Japanese yen. Because as all of us know, in Japan, they've been in the very low interest rates for very long. So obviously the rate from in the US is higher than in Japan. So essentially when you're borrowing US dollar, you are incurring the borrowing cost on the USD. And when you're holding an asset denominated in the Japanese yen, you are not you're not receiving any interest. So the interest rate differential would be negative, essentially because you are borrowing at a high borrowing cost to hold something that yields you a very little or no interest rate returns. So that is an example of the interest rate differentials. So these would be incorporated into a single column or a single item called the swap lah. Okay. So next up, we also have something called the cost of carry. So cost of carry, it means different things on depending on what asset that you are trading. So let's say for commodities, you have to pay a cost of carry for like a storage cost, and for equities, you would need to pay cost for like a dividend. All those would be adjusted. Okay, so speaking of equities, we can move on to the next portion, which is corporate actions. Okay, so we shared earlier that by trading share CFD, back to the share CFD example, you are just trading the price difference while you do not hold any underlying asset. So what happens when the underlying asset actually issues dividend, or they issues a bonus share? So one good thing about CFD is that you are also entitled to these corporate actions. So let's say you're holding a long position, and when the company announces a dividend adjustment, because normally after a dividend is announced, the share price tend to drop to account for the dividend lah. So for those who are takers, let's say from perspective of someone who's holding physical shares, okay, so the dividend will somehow offset the price drop. So to the investor, like, he's well compensated, like the price drop, and then he received dividend also. But the price drop in the actual underlying market would also affect the price in CFD. Okay, so to offset the fact that they do not receive the actual dividend, the amount equivalent to the dividend would be credited to this CFD position. Okay, so let me repeat. So let's say if you're holding a long position on this share on the X date, okay, then you would be compensated for the price drop as a result of the dividend issue. Okay, so you'll be credited back, and all these all these cash flow will be adjusted back into the swap. Okay, in the alternate scenario, let's say you are shorting this stock, and then the share price actually dropped, but you wouldn't benefit from the drop of the price, because you would still be accounted for that change lah. So you'll be still credited, debited money. So okay, so at the end, we wouldn't really benefit or lose out from that lah, from as compared to holding the underlying shares. Will be compensated from those in CFD. Okay, so other scenario like the stock split or bonus issue, you will also be entitled to the adjustments, and all that will be going back into your swap. All right, so it depends. The swap could be negative, it could be positive. So just looking at the financing cost, it normally tends to be negative lah, because you normally do incur the borrowing cost. But coming down, let's say you have like a corporate actions and dividend adjustments, so sometimes your swap would be positive. Okay, so I think those are the two costs for trading CFDs. Okay, so it is just the spread and the swap. There will not be any commission or platform fee. It is pretty straightforward. Okay, so let's talk about why people trade CFDs. Not only CFDs is favored by retail traders. Actually, a lot of institutional traders or hedge funds, they use this instrument as a way to hedge against their portfolio, or also to speculate the market and to profit without owning the underlying asset. Okay, so first reason that people like to trade CFDs, or this is more pertaining to, I think, like retail traders lah, because CFDs, they typically have smaller or more affordable contract sizes. So this means that you'll be able to enter into a CFD contract with a modest amount of capital and trade as small as one share. Okay, so this is particularly true because let's say if you're investing in underlying market, normally there's this thing called the bought lot, which is the minimum amount of shares that you can that you should buy in, and also there's other things like the minimum commission and all. But for CFD, you can it depends on contracts, but for most of the contracts, especially on the SGX ones, you can trade as low as just 1 share, or a 5 share to 10 share. You can always start small when you're just starting out, so you wouldn't like risk too much of your starting capital when just starting out. So CFD has one of the benefit, you can start small. And secondly, it is also that you are able to trade in both bull and bear markets. You are able to enter a long or short position to take advantage of both rising and falling markets. So, I mean, coming to this point, it really, like CFD traders, they don't really have to be concerned about, the market's going up or it's going down. So basically, they just follow the trend and perform some technical analysis. So essentially, during any cycle of the market, CFD would be a useful tool for you to take advantage of the price movement. Okay, so thirdly, it is also there is no expiry date or risk of delivery, because for futures, some futures, at the expiration date, you have to take physical delivery, or if you do not want to take physical delivery or cash settle it at an unfavorable price, you would have to be mindful, to roll over the contract before the expiry. Okay, so with CFD, there is not much of a hassle with that. One cons, however, not really cons, just that a trade-off for CFD is that you would incur the swap, as I mentioned earlier. You would incur the swap as you hold the CFD position for a longer period. Okay. Okay, so I think I've mentioned this a few times. CFDs, it is a zero commission trading product, and also capital efficiency. Okay. And lastly, one of the more interesting facts about CFD is that you can hedge your position. So essentially, it lets you hold the opposite position of the same CFD contract. So, this can go in a few ways now. So let's say you're holding a long CFD contract for a longer term. Then in the intermediate term, you would, wish to ride on some downside. There's some correction. Then you can enter a short position at the same time. So, the long and the short position, they can be open at a simultaneous time. One doesn't cancel another out. Okay, so that is one of the properties for CFDs. You're able to hedge. Okay, so as a personally, I believe this is one of the more interesting selling feature for CFD. It's like you can really hedge against your asset. So under these cases, so let's take an example of you hold a share of a share in the actual market, holding the actual shares lah. Okay, you believe that the share is actually solid fundamentally. Okay, it's solid, but due to some general market sentiments or the risk of mode that the market is tumbled for temporarily, so you may look into these times to trade with CFD to the downside while you're holding the actual position. Okay, so on this chart right here, it is an example of a CFD. So let's say you were holding sometime since last year. It has rallied pretty crazily towards like September, October. So you hold the actual underlying position in Tesla shares. You are really glad that it's going up, but at the same time, you think that this may not be sustainable. Okay, but you wouldn't want to sell out the whole position. You want to hold it for long term. You want to hodl it. Okay, at the same time, you can take advantage of CFDs to ride on the downside. So you see right here. So it depends on your risk appetite, you may see that it's going so too high. You look at the trading indicators like the RSI, it suggests that it's overbought. Okay, so therefore you like to short sell it. You are able to do that with CFDs. Okay, so that is the one strong selling point for CFDs lah. Okay, so I think this is the first session. We try to keep it light and at the same time informative. So I feel it's not too much, to digest. So in the second and third session, we would actually cover more information that will be useful in your CFD trading journey. Because actually to start trading, like we get a lot of questions about do you have any advice for people who are just starting out in CFD trading or in Forex trading? Our answer is always, to start with the fundamentals and, to learn the fundamentals, what they mean. And more moving on, you would also, look into fundamental analysis, technical analysis, which we will cover in next week's session in more detail. So next week, we'll talk about also some differences between holding a stock and a stock CFD, understanding the risk involved in stocks and leverage CFDs, and also some examples of stock CFD trade lah. Okay, and also in the next session, we will demonstrate some trades or to guide you around our trading platform, the Phillip MT5. Okay, so that would be for next Thursday. So for those of you who have not signed up for this session, or you may want to get your friends to join, you may scan this QR code right here. Okay, I'm gonna give you like a short time for you to maybe take a picture for your future reference. Okay, so this is for next week. Okay, so by the end of the first and second session, okay, you would have known what is the CFD, the fundamentals of it, how they work. And in the second session, fundamental analysis and technical analysis. Okay, so I think the third part, which is also very important, it somehow gels the whole thing together, it gels your learning together, where we'll talk about what is a trading plan. And because risk is everywhere. Like we talk about Forex trading, we talk about CFD trading. All these are leverage product. It also comes with a high level of risk. But a very important part, and a part that we cannot miss out, is risk management. So we cannot emphasize this enough. It is risk management. Okay, so in this portion, we will talk to you about what is a trading plan, what are some of the risk management tools you can utilize, what are some of the general risk management guidelines that you should abide to in order to have a sustainable and profitable trading journey long term. Okay, so all this is really about education. It's not about high risk, high reward. Go inside, you risk losing your whole account and all. It's all about managing the risk lah. Okay, so we would also talk about the post trade management in this session. Also do some platform simulation on some of the tools that you can use to facilitate in your trading. Okay, so same, you can take a photo of this QR code or send it to your friends for them to join this. Okay, and also one thing to mention, I think all of you are mostly uni students, and at the end of this course, what we would do is that we would give out a certificate of completion to all of you lah, to show that you've attended this webinar series. Because what we're trying to do is engage with Students Club and to try to bring as much value as you can. So with this kind of certificate of completion, it may be useful for your future job search in case you're interested to come back to this finance industry. Yeah, so that's something bonus that we've offered to you students. Okay, so that is all the session. Okay, and in case you would like to start playing around with the platform before we go through in next week's session, we highly recommend you to just download free demo. It is completely for free. You just scan this QR code, you will register for a free demo. After which you will receive instruction to download the platform and you can play around with it. Because next week we would go into using the platform. How I think if you can start looking into the platform from now to next week, you should be able to benefit better in the next week's session. Okay, so just scan this QR code for a platform demo. Okay, so a little bit of information about the trading platforms that we have. So this is more about a company. Basically, we offer two trading platforms. The first is the Phillip MetaTrader 5, which is what we've talked about, CFD trading, so to hedge your positions if you have a long-term cash market. Okay, so with this Phillip MetaTrader 5, you can also trade precious metals, Forex, like gold, silver, and all that lah. Okay, so you can trade from very small sizes, from micro lots for Forex, and we also have a bunch of cool trading tools like Trading Central and all that. Okay, and we'll talk more about this platform in next week lah. Okay, so secondly, we also do have another proprietary platform, which is the Phillip Nova, where you can invest in actual cash stocks. Okay, so actual cash stocks. So that is Phillip Nova. Yeah, apart from stocks, you also have futures and Forex, but I think for you guys it would be mainly a stock trading platform with zero custody fee and no platform fee. Okay, and one interesting thing about this Phillip Nova platform is that it has the cheapest commission for HA stocks in Singapore lah. Okay, so if you guys are interested, you guys can scan on this QR code. Okay, so a bit of information for Phillip MetaTrader 5, right? To open an account, you would need to pass this customer knowledge, customer knowledge assessment, where because it is like a leverage derivative product, you will need to prove to have the sufficient knowledge in order to open an MT5 account. So you either need to have a degree or a diploma in related field like finance, or if you don't, you only have to take a quick online e-learning. So once you've taken that e-learning, then you'll be able to open an MT5 account lah. But for Phillip Nova, there's like no requirement. You can just open an account with no minimum funding and all. It's basically it's pretty straightforward lah. You can just open an account free. Okay, so I think that is the offering. And lastly, we want to share with you something cool that we've been doing is the Telegram channel. I think I'm not sure if all of you are on that, but we actively push this for some time now. It's the Phillip Futures Young Investors channel. So in this channel, we will update daily. So basically, there are few content like we have a daily market write-up on the US market, and we also do cover information on the crypto market as well. So every day we will condense the main market moving news into this bite-sized readable content. So at one glance, you'll be up to date with the latest market movement. We also talk about one stock each day. In case you're looking for trade ideas, what stock is hot. We do cover one stock a day. And apart from that, if you're interested to learn about technical analysis, we do a daily technical analysis content on a particular stock every day. Okay, so we would identify things like a rising wedge, bullish pennant, double head and shoulders, all that. So we would so basically this Phillip Futures Young Investors channel is more for like educational lah. So the way we curate the information is more from an education perspective. So for those of you who are interested to join this channel, you could scan this QR code and to share with a friend as well. Okay, so I think to wrap up the session, I think thank you guys for attending. We do strongly recommend you to join in our second or third session because that would make this course complete lah, because we want to make it into a bite-sized 3-part series. Okay, and also feel free to share the download link, also the registration link to your friends, so that we can all learn together on this 3-part webinar series. Okay, so I think if that is all, we would call this session a day. Okay, so thank you very much for attending and for paying attention. We would see you again in next week's session. All right, thank you very much.